And finally, 15.4, analyzing the balance sheet. Same thing, we'll do vertical analysis. And that means we're going to take numbers within the specific areas of the accounts and then compare them to a base. Now, when we were looking at the income statement, the base, the one that was used as the denominator, was net sales. Net sales for the income statement. For the balance sheet, the base is going to be total assets. So what you'll be given is dollar amounts. So as an example here, we have Apple Inc., the consolidated statements, you have the dollar amounts. The dollar amounts will be given, and then you can sum up the totals. But when it's all said and done, you'll need to come up with total assets. In this case, it's $290,479. Now this is in millions, but I'm just going to read the numbers as they're shown here. So for 2015, when we're doing vertical analysis, we'll use total assets as the base. So every one of these numbers is then going to be divided by the base being total assets. So as an example, cash and short-term investments, $41,601. So let's do that. So I'm putting some space here, but just so that it kind of looks spatial-wise similar to what is in the textbook. But we're taking cash and short-term investments, that dollar amount, and we're going to divide it by the base, which is total assets. Total assets is 290. So 290,479. So the percentage is 14.3%, 14.3%. And you'll do that for each one of these, accounts receivable and other. So the amount for accounts receivable and other is 30,343. We'll take that, we'll divide it by the base. The base is total assets, 290,479. Percentage is 10.4%. 10.4%. And you do that for every one of these. You even do it for liabilities and stockholders' equity. So you'll take, let's go ahead and look at long-term debt. Let's pretend way down here, long-term debt. And the dollar amount for long-term debt is 53,463. But we'll take that dollar amount, we'll divide it by total assets. The base is always total assets. And we come up with 18.4%. 18.4%. Now just remember that the dollar amounts for each item will be divided by the same year total assets. So 41,601 is divided by 290,470. This is 2015. If we're going to analyze 2016, then we'll take each one of these line items, let's say total current assets, 106,869, and we'll divide that by the total assets for 2016. So in this case, it's 321,686. So this 106,869 divided by 321,686 is 33.2%. And then we also do horizontal analysis, and that's comparing year to year and whether things have gone up or down. And we're going to do the same thing we did for the income statement. We're going to take the change between the 2 years. So in this case, cash and short-term investments for 2015, it was 41,601. For 2016, it was 67,155. We'll compute the difference. This minus this. We'll subtract 15 from 16, or take 16 and subtract 15. That gives us an amount of increase or decrease. In this case, it went up, so that's an increase of 25,554. So the dollar amount change was a positive 25,554. Now we'll take that change and we'll divide it by the base year. The base year in this case is 2015. It's the first year. So 25,554 divided by the base year of 2015 of 41,601. This divided by that will give us 61.4%. And we do that for every one of the accounts. Those are just the current assets, but you could do it for any and all the accounts listed on the balance sheet. Now we can also do what's called financial ratios. And in some cases, we look to determine what the liquidity is of a company. And liquidity refers to the firm's ability to raise cash quickly without being forced to sell assets at a big loss. So we'll look at the current ratio. And the way we come up with the current ratio is we take current assets and we'll divide it by current liabilities. So you'll have the formulas there. You just have to, whenever it asks you, well, what's the current ratio, you can refer to your textbook and figure, okay, what is the current ratio? It is current assets divided by current liabilities. So let's take a look at how this works. So for example, number 3, they say, the balance sheet shows the current assets for September 30th, 2016 to be 106,869. That's the current assets. Now we're still gonna compare. This is more like vertical analysis, not the horizontal. Horizontal compares year to year, but this is not comparing year to year. This is the 1 year that we're analyzing within that 1 year. So we're taking, for 2016, we're taking the current assets of 2016, and we're dividing it by the current liabilities for the same year. So 106,869 divided by 79,006, and that gives us 1.35. So our current ratio is equal to 1.35. That means for every dollar we have that we owe in current liabilities, we have $1.35 that it's ready to pay for that liability. We can also look at what's referred to as the asset test ratio. The asset test ratio is taking liquid assets divided by the same current liabilities. Liquid assets. So what are we going to do? We're going to exclude things like inventory, okay? Because we don't consider inventory to be a liquid asset. So as an example here, compare the asset test ratios for Apple for 2015 and 16. Rounded to the nearest hundreds, okay. For 15, it appears that our current assets are 89,378. What page was that on? I think that was, so on page 628, we'll see that the current asset section is broken down between cash and short-term investments, accounts receivable, and inventory. So when we're doing the asset test ratio, we're just going to exclude inventory. So we've got 15 and 16. The total current assets for 15 are 89,378. We're going to subtract inventory of 17,434. And that's going to give us the dollar amount we need in order to compute the asset test ratio. So that's going to be 89,378 minus 17,434. That gives us the 71,974. Now we're going to take that and we're going to divide it by current liabilities. That's the same current liabilities that we've used before. So that's going to be 80,610. The asset test ratio is equal to 0.89. That was for 2015. For 2016, the same thing. We're going to compare the current assets. We're going to subtract inventory. So now we're just left with liquid assets. And in this case, it's 96,454. We're going to divide that by the current liabilities of 79,006, and that gives us 1.22. Often we're asked to find the average of a particular dollar or account. And whenever we're talking about the average, we may have the ending balance, but we're saying, well, how do we get the average balance? And the way we do that is we figure out what we started off with, what is the beginning, and then we add to that the ending, and we divide it by 2. So then if we know how to compute the average, then we can use that average as a computation for another ratio. As an example, this is finding the ratio of net income after taxes to average owner's equity. Average owner's equity. Well, we need the average owner's equity in order to do this ratio. So the computation is going to be taking net income after taxes divided by the average owner's equity. So let's take a look at an example here so that we know exactly how this is computed. So find the 2016 ratio of net income after taxes to average owner's equity for Apple. Well, the first thing we need to do is compute what the average owner's equity is. And we have to scroll up, look at that formula again. It's taking the beginning plus the ending and dividing by 2. Now, you might get confused. You're saying, well, how do I come up with the beginning? Since we're dealing with 2016, then we know what the ending is. That's whatever's listed on the balance sheet. But now what is the beginning? Well, the beginning is going to be equal to the ending of the prior year. So what we'll do is we'll look at the balance sheet and notice that the stockholders' equity increased from 119,355 in 2015 to 128,249 in 2016. So back to page 627, we'll see the stockholders' equity for 15 was 119,355, and for 16 was 128. Now we're looking for the average for 2016. We have the ending, that's 128,249. The beginning is equal to the prior year's ending. So those are the $2 amounts we want, 119,355 and 128,249. Beginning plus the ending. We're going to take those two, add those two together, just like it says here, finding the average. We add those two together and then we divide it by 2. So add these two together, divided by 2, we come up with 123,802. Now that becomes the denominator for this ratio. 123,802 becomes the denominator. So that's going to carry down to right here, 123,802. And then the numerator is going to be the net income. And net income, if you go back and look on the previous pages, is 45,687. So we'll take 45,687. By the way, this is for 2016. So 45,687 divided by 123,802 equals 36.9%. So here is a summary of the ratios. Those formulas you can look up if you ever come across those on your problems. And that concludes 15.4. That concludes chapter 15. And that concludes the last chapter we're going to cover in this semester.